So boom and crash is one of the most traded instrument on derivative platform. Yet most people lose money when they trade boom and crash. And why is that? This can be because of a lot of reasons. But today I want to share with you three of these most common reasons why you probably are losing money when you try to trade boom and crash on the market. You see, these synthetic indices that are provided by derivative, they mimic real world markets, but they are not created specifically for you to make money. They are created for you to lose money, and when other traders make money, you lose money, because when buyers lose money, sellers will be making money, or if sellers are making money, buyers are going to be losing money. Okay, so these indices are not created for you to make a lot of profits until you become a good trader and you can be on the side of the people who are making money on the derivative platform. Now, I believe that when derivative created these indices, they wanted also to make money because they are the market maker, okay? But the problem is they cannot just create advantage by moving the market to the different direction, because when they are buyers, they will be also sellers. So they know that there is always going to be a balance of buyers and sellers in the market. So how do they create an advantage over the traders that are using their platform? The best way, and I think the way that they go with, is using emotions for you to make sure that you probably are going to lose money as soon as you deposit. And how do these emotions come into play when you are trading these indices? The first and easiest way that these emotions can come is because of these spikes and small tick candles, and I'm going to show you why I say this. But first, let's talk about the first reason why you are probably losing money when trading using the derivative platform. The first reason is using the smallest time frames, like the 1 minute time frame. And let me explain why I think it's a bad idea for you to try to trade on the smaller time frame, right? So if you go to a smaller time frame like this, like the 1 minute time frame, you are going to see that if we try to draw maybe support and resistance, it's not going to come up as accurate as it can be on higher time frames. You can see that this market is not respecting any of these support or resistance zones. It's just going up and down on these zones. Now, if you go to the higher time frame and we try to draw support and resistance levels, you are going to see that this market is likely going to respect these levels of support and resistance more than what it does in smaller time frames. So if I draw a support line right here, and if I extend it, you are going to see that this market was moving and it have been touching these levels like once here, second time here, the third time, fourth time, fifth time, sixth time right here. So you can see that this instrument is respecting this support and resistance levels. So if you draw a zone of support and resistance on any zone that looks significant, you are going to see that this market is likely going to come back into this zone and respect this zone again in the near future, or whenever when the market comes back to these zones, it respects these zones. That's how boom and crash works on a higher time frame. But if I go to a 1 minute time frame, you are never going to see this. So this is number one reason why you're probably failing. You are using smaller time frame, and these smaller time frames doesn't work well for price action. Number two reason why you are probably losing money when trading derivative, when trading boom and crash on derivative, is because you are using huge lot sizes, and this comes because again of these smaller time frames. So let's go back to the 1 minute time frame and let me show you what I mean by this. Now, what happens here is that if you place your trade right here, and if you are trying to get these small tick candles right here, right? So each and every one of these small tick candles, depending on your lot size, if you are using a standard lot, is going to be worth around 50 cents. Okay, so each and every one of these candles is going to be worth around 50 cents if you're using a standard lot, which is a 1.00 lot, right? If you are using the minimum lot, that means you are making like 1 cent, 3 cents for each and every one of these tick candles, or maybe you're making at best 5 cents, let's just say 5 cents on each and one of these candles. So if you catch 10 of these candles, you are only making like 50 cents. So when that happens, most people will not tolerate that happening, so they will just hype up and they will just increase their lot sizes, and then they'll start using like placing like 10 trades at once, or using like 7 lots, 10 lots, 15 lots in one trade, so that they make sure that if they just get one of these tick candles, they will probably you are probably going to make like $5, $4, or maybe you're probably making like $2. So if you catch 10 of these, you're making like $20, and that will be a reasonable trade. Okay, but the problem with that is that when these spikes comes, you never know how big this spike is going to be. So let's say you were placing your trade right here. Let's take this as a good example. Let's say you were placing your trade right here, and you use 10 lots right here, and you make $20 with the one with this. Let's say you are using 10 lots right here, and you make like $5 with this small tick candle, and you make another $5 with this small tick candle, and then at this point maybe you have $20, and then look at this, how big this spike is. Like, so if from here to here is was a promise of maybe $10 in profit, how big do you think this loss is going to be? It's going to be maybe $100. So when this one spike comes, if you have an account which is less than $100, you probably blow your account. You definitely blow your account with this one spike, which is the number 2 mistake, using bigger lot sizes. So what do? You go to a higher time frame and then use your smaller lot sizes, and now you are no longer worried about these spikes. You are worried as much as someone who is trading maybe currencies, because on bigger time frames it's always the same how this market moves. So you're going to be using bigger stop losses and take profits, which means your lot sizes can be smaller, and if the market goes against you, you can protect your account. Number 3 mistake that you are probably making, or number 3 reason why you are not making money on boom and crash, is you are trying to chase these spikes and tick candles. And this is this exact same thing that I've been talking about right here. If you are trying to catch these spikes and these tick candles, so what is going to happen most of the time is you're going to come into this market, and you probably come and see a point where the market is doing this, and you say, okay, this is crash 1000, so all I have to do is keep selling, because when it crashes I'm going to make a lot of money. But this is not true, okay? Because what will happen most of the time is you probably going to get a moment like this where you think, okay, this is boom and crash, and I'm going to be just selling to make profits. So maybe you sell at this point. Let's say you sell here, and you are thinking that, okay, the market will probably go to the downside from here, and then the market starts going up, and then when it goes maybe to this level, you exit, and you think that, okay, maybe you don't exit, you say, let me add another position, or you put your stop loss and you get out of the market, right? And then you say, okay, let me sell again, because this is a crash market, it will likely drop, right? And then again it doesn't, and it doesn't for a long period of time. You can see how many tick candles we have from here. Okay, so as much as I would say avoid to catch these spikes, I will also say so you can see that there's sometimes when you have maybe one tick candle, and you believe that, okay, so this market is going to the downside, but also there's times like this when the market just goes into a series of tick candles and never spikes, right? So you can see that it's very, even if you are trading this crash 1000, you can see how big this trend is. And even if I draw this zone from here, you can see how big this uptrend is, but it's in a crash market, but you can see how big the uptrend can be. So it's not true to say if it is a crash market you just have to sell, if it is a boom market you just have to buy. It doesn't work like that. Okay, so you need a strategy, and most likely you need to go to higher time frames. If you go to higher time frames, let's go to the 1 hour time frame again and see how big this move is. Okay, so you can see on the higher time frame the market is going to the upside. Okay, this is the move that was creating all those tick candles, right? But on the higher time frame, you can see that, you can clearly see that, okay, this market can go into an uptrend, it can go to the downtrend. But the good thing about boom and crash is it clearly shows you good zones. If you are using price action, you will probably make better or high probability trades if you are trading boom and crash. Okay, so If you like this video, make sure you check out in the description. We have a free course that you can get right now. It's completely free. Make sure you check out the first link in the description below. Thank you for watching, and I'll see you in the next one.